Long before Alexander Hamilton, long before the United States even existed, one empire had already cracked the most dangerous problem of power: how to fight endless wars without running out of money. Britain did not win because it was richer or braver or more disciplined. It won because it learned how to turn debt into a permanent weapon. In 1694, out of sheer desperation, Britain built a system that allowed it to borrow endlessly, pay interest reliably, and fight wars its enemies could never afford to finish. This is not a story about banks or bonds. It is the origin of a machine that converts future income into present power and turns creditors into loyal stakeholders of the state. And once you see how it worked, you'll recognize it everywhere. If this way of seeing history sharpens how you understand money and power, subscribe to History of Finance Decoded. Every like, every share, every subscription helps us uncover the systems that still govern the world today. In the late 17th century, Britain was not the global power history later remembers. It was exhausted, indebted, and militarily overstretched. By the 1690s, England had been fighting almost continuously for decades against France, against internal instability, against the limits of its own treasury. Taxes were already high, public trust was fragile, and traditional borrowing methods were failing. Every war demanded cash upfront, but the state could no longer raise it without risking revolt or default. This was the core dilemma. Britain needed a way to fund power without breaking society. What followed was not a financial innovation born from theory or ideology, but a desperate response to survival. In moments like these, history doesn't move forward by design. It moves forward because the old system can no longer hold. The turning point arrived in 1694 in London, during the reign of William III. Britain was locked in an expensive war with Louis XIV's France, a conflict it could not afford to lose and could not afford to continue. Traditional lenders demanded crushing interest if they would lend at all. Confidence in the crown's promises was low after repeated defaults earlier in the century. That year, a group of private financiers proposed something radical: lend the government a large sum at manageable interest, but in exchange, receive permanent privileges and institutional backing. The proposal was accepted out of necessity, not conviction. With a royal charter, the Bank of England was born, not as a neutral institution, but as a war financing mechanism designed to stabilize borrowing and restore credibility to state debt. What made the Bank of England revolutionary was not the money it raised, but the structure it created. For the first time, government debt became permanent rather than temporary. Bonds were no longer tied to a single war or crisis. They rolled forward indefinitely, serviced by regular interest payments. This transformed creditors from short-term opportunists into long-term partners of the state. The government no longer needed to fully repay principal. It only needed to maintain trust and keep interest flowing. In return, lenders became deeply invested in the survival and stability of the British state. Debt stopped being a sign of weakness and became an operating system. Britain had quietly discovered that credibility, not gold, was the true foundation of financial power. This system changed warfare itself. Britain could now mobilize resources faster and more reliably than its rivals. While continental powers relied on direct taxation and plunder, Britain financed war through credit markets anchored in confidence. Interest payments were funded through predictable tax streams, spreading the cost of war across generations rather than forcing it onto the present. This gave Britain strategic patience. Wars could last longer, fleets could be rebuilt, losses could be absorbed. Creditors, now tied to the state's success, had every incentive to support stability rather than rebellion. The result was a feedback loop. Military success reinforced financial credibility, which lowered borrowing costs, which enabled even greater military reach. By the early 1700s, Britain's debt had grown dramatically, but so had its power. What looked like fragility on paper was in reality strength in structure. Interest payments functioned as a loyalty mechanism, binding wealthy citizens and institutions to the government's survival. Default was no longer just a financial failure, it would have meant political collapse. This was the quiet genius of the system. Britain did not eliminate the cost of war, it transformed it into a manageable, invisible burden. And although few recognized it at the time, this debt machine would become one of the most influential financial models in history, copied, adapted, and refined by future states seeking power without resistance. As Britain's debt system matured, something subtle but powerful happened inside its society. Government bonds stopped being abstract instruments and became prized assets held by merchants, landowners, and institutions. By the mid-1700s, owning state debt was seen as safe, respectable, even patriotic. This changed the relationship between citizens and the state. Wealthy classes were no longer merely subjects, they were stakeholders. Their fortunes rose and fell with government solvency. This alignment reduced internal resistance and made political stability financially rewarding. The British state had learned a quiet lesson. When creditors depend on you, they defend you. Debt was no longer borrowed money, it was political glue holding the system together. This structure gave Britain an advantage its rivals struggled to replicate. France, for example, relied heavily on direct taxation and short-term loans, often forcing defaults that shattered trust. Britain, by contrast, protected its credit reputation at almost any cost. Even during defeats, interest payments continued. This consistency mattered more than victory. Investors learned that British promises endured across reigns, parliaments, and wars. Over time, this reliability lowered borrowing costs, allowing Britain to finance conflicts more cheaply than its enemies. The battlefield advantage was not just cannons or ships, it was confidence. Financial credibility became a strategic weapon, one forged slowly but deployed decisively. By the late 18th century, Britain's national debt had reached levels previously unimaginable. Yet instead of collapse, the empire expanded. Colonies were defended, trade routes secured, and naval dominance maintained through borrowed capital. Crucially, debt growth did not trigger mass unrest because its burden was diffused. Taxes were indirect, consumption-based, and gradual. Most citizens felt pressure without fully seeing the source. This invisibility was essential. Open taxation breeds resistance. Interest-funded debt breeds tolerance. Britain had stumbled upon a principle future governments would refine. Populations resist pain they can see, but endure costs they can't easily trace. This system also reshaped political incentives. Governments no longer needed unanimous public support to wage war, only continued access to credit markets. Policy decisions increasingly reflected what reassured lenders rather than what inspired voters. Stability, predictability, and institutional continuity became paramount. Radical reform threatened credit confidence, so moderation prevailed. This didn't eliminate democracy, but it constrained it. Power shifted quietly toward financial structures operating beyond election cycles. Britain had not created tyranny, but it had reduced volatility. The state became less responsive to immediate public emotion and more responsive to long-term financial survival. By the time Britain's North American colonies began questioning imperial authority, this debt system was already deeply entrenched. The empire they resisted was not just military, it was financial. And when those colonies eventually broke away, they didn't reject Britain's model entirely. They studied it, they debated it, and one man in particular understood its true power. The story of permanent debt was about to cross the Atlantic, carried not by armies, but by ideas that promised strength without visible sacrifice. When the American colonies won independence in 1783, they inherited freedom, but also financial chaos. The war had been funded through improvised loans, depreciated paper currency, and promises that could not easily be kept. The new United States had no unified tax system, no central credit authority, and no international credibility. Foreign lenders viewed the republic as unstable and temporary. Domestically,
Unpaid soldiers and creditors grew restless. The revolution had proven America could fight, but it had not proven America could govern. Survival now depended not on ideals, but on whether the new nation could convince others it was worth lending to. Alexander Hamilton understood the danger immediately. In 1789, as the first Secretary of the Treasury, he argued that national debt was not a weakness, it was a tool. Drawing directly from Britain's example, Hamilton proposed that federal government assume state war debts and honor them in full. This was controversial. Many saw debt as a moral stain. Hamilton saw something else, a mechanism to bind the wealthy to the success of the republic. If creditors depended on federal stability, they would defend it. Debt, properly managed, would convert private interest into public loyalty. Hamilton's vision extended beyond repayment. He insisted on regular interest payments, predictable taxation, and the creation of a national bank to manage government finances. These were not bureaucratic details, they were signals to the world. The United States would not default, it would not improvise, it would behave like Britain had learned to behave. This credibility lowered borrowing costs and attracted capital from abroad. Almost immediately, U.S. bonds began trading actively in European markets. America's political independence was new, but its financial language was already fluent. Critics feared this system favored elites, and they were not wrong, but Hamilton believed inequality of influence was preferable to national insolvency. He argued that debt created order, discipline, and continuity. Governments that defaulted faced chaos. Governments that inflated recklessly faced distrust. Permanent debt, by contrast, created long-term incentives. The state became careful, not reckless. Radical change became expensive. This was not democracy unchecked, it was democracy constrained by credit. Hamilton's model deliberately traded flexibility for durability. By the early 1990s, the United States had adopted the core logic of Britain's debt machine with one crucial difference. America tied debt legitimacy to constitutional governance rather than monarchy. Power was still constrained, but now by institutions rather than bloodlines. The formula remained the same: borrow broadly, pay reliably, tax quietly. This was not imitation, it was adaptation. And once established, the system proved difficult to reverse. The Republic had learned the same lesson Britain learned decades earlier. Once a nation governs through debt, it rarely returns to governing without it. Once embedded, the debt system reshaped political behavior in subtle ways. Governments became less focused on immediate public approval and more attentive to long-term creditworthiness. Decisions were no longer judged only by voters, but by bond markets and lenders assessing risk decades ahead. This shifted power away from sudden popular pressure toward institutional continuity. War, infrastructure, and empire could now be financed without exhausting treasuries up front. The cost was deferred, fragmented, and normalized. Debt did not remove limits, it changed where those limits were felt and by whom. Britain's advantage was not endless money, but predictable behavior. Creditors trusted that interest would be paid even during crisis. This trust allowed Britain to outlast rivals who relied on conquest, plunder, or forced levies. France, Spain, and later Napoleonic Europe struggled because their systems broke under pressure. Britain endured because its debt was boring, routine, and legally protected. Stability, not brilliance, became the ultimate weapon. History rarely rewards the boldest spender, it rewards the most credible borrower. By the 19th century, this model spread across the industrializing world. Nations learned that credibility reduced costs and permanence reduced panic. Central banks, bond markets, and tax systems evolved together, not by conspiracy, but by necessity. The system favored order over speed, repayment over reinvention. Revolutions could topple rulers, but rarely erased debt. Financial continuity outlived political change. Once a society accepts permanent debt as normal, it reorganizes its expectations around it. Slow growth, managed inflation, and institutional patience replace dramatic resets. This is why modern governments rarely aim to eliminate debt. Doing so would dismantle the very mechanisms that stabilize their power. Debt anchors alliances, disciplines spending, and binds future administrations to past commitments. Inflation, default, or restructuring are treated as emergencies because they threaten trust itself. The machine survives because it works, not perfectly, not fairly, but reliably. What began in 17th century Britain as a wartime improvisation became the backbone of modern statecraft. Understanding this history changes how you see today's world. Debt is not simply an economic number, it is a political architecture built over centuries. It explains why governments borrow instead of tax, inflate instead of default, and protect institutions above short-term relief. Britain did not invent power, but it perfected how power could be financed indefinitely. And once that lesson was learned, it was never forgotten. History does not repeat itself loudly, it repeats itself quietly through systems that keep working long after their origins are forgotten. If this episode sharpened how you see power, debt, and history, subscribe to History of Finance Decoded. Every like, every share, and every subscription helps us keep uncovering the systems that quietly shape the world.